Hi, everybody, and welcome again to the REI Foundation podcast with Jason and Peely. Today, we welcome Ray Williamson. Hi, Ray.
Hi, good morning, Peely. Good morning, Jason.
Good morning.
Hey, Ray, how's it going?
It's going really well. So I appreciate you guys inviting me and look forward to our discussion today.
Well, thank you so much for coming on.
So Ray currently works at LendingHome, and we want to go over his quick run on the bio. He's got quite an impressive track record. And before we jump into it, we thought it was very important. We're talking constantly about flipping homes, investing in property. And one of the key pieces, of course, is if you don't have 100, 200, 600,000 just laying around that you can throw at these actual projects, how are you funding these projects? And that's why we have Ray to really help us shed some light on, one, what they do, and two, how they help investors and how an investor can best set up to work with a company like LendingHome. Ray is a 28-year financial services leader that has worked in both consumer mortgage space along with the direct-to-consumer financial planning space. So we have some experience, we can say today. We're ready to go. His experience in the mortgage industry involves a 17-year run with First Financial that included starting out as a processor and developing into a production vice president that was responsible for 70 employees in both sales and operational roles. The team originated over 1.1 billion, that's with a B, of annual production that was number one or two in a company of 35 territories.
Wow.
Invested in 5 years in the financial planning space with Northwestern Mutual, working with high-income earners, executives, and companies under personal insurance and retirement planning needs. This experience really drove his passion to truly do what he felt was needed for busy individuals. He was responsible in generating 100% of his own leads and business, along with keeping each client educated and updated on the trajectory of their plans and the industry changes that could affect their goals. Next, he spent 4 years at 2 mortgage startups. First startup was a 10-month period with Privlo. They were a consumer mortgage company attempting to compete in highly competitive consumer mortgage space, and specifically with income and credit challenged borrowers. Their funding ran out and they were forced to close. We can touch on that. That would be great. And his role there was to involve building out their operations staff and a system that would support the growth and scale needed to serve borrowers and return investors' money. And now currently, he's working at LendingHome. The company serves the residential fix and flip market by providing both funding for the acquisition of properties and the rehab associated with getting those homes resold at a profit to both the borrowers and LendingHome. He served in 2 roles. From 2014 to August of 2017, he ran a 50-person operations team that gave support to a sales initiative and protected the investments and expectations of other investors. Currently, he oversees the Midwest and Eastern territories of business from our most experienced borrowers, and he helps onboard new borrowers that can benefit from his financing and help retain borrowers already using the platform to grow their business. Ray is married to Ruth Williamson for just over 28 years, has 4 children, 2 boys and 2 girls, a 26-year-old son, Ian, who attended Cal Poly SLO and is on his way to becoming a firefighter. Awesome. And a 24-year-old daughter that is set to graduate from Chapman University of May 2018, a 21-year-old daughter that is set to graduate from Marquette in May 2018, and lastly, a 17-year-old son that is a junior at Cathedral Catholic High School. Well, Ray, you have your hands busy with a ton of college. So
wow.
I'm sure
congratulations to all your children on the cusp of their graduations.
Yeah, thank you very much.
Good.
They've been busy. It's all of them.
Well, Ray, we just spent a few days with you that were amazing down in Pensacola. Learned a lot about your service. You saw with the group we work with, how we work, and we just thought it was key to be able to chat with you a bit more and help our listeners really understand from a financing perspective how they can best prepare themselves to, 1, be an attractive candidate, 2, what kind of projects, how to look at a project from a lender perspective, and then 3, how to really scale their business using a service like LendingHome. So before we get started with that, we like to typically have people why don't you just tell us what you do in just a quick blurb?
What I currently do at LendingHome is I work with what we consider to be the more experienced borrower channel. And a very quick definition of kind of most experienced is, since we only provide fix and flip financing, meaning we don't provide conventional mortgages, we don't provide rental financing or ground up construction. We're identifying people that are doing just that. So they're acquiring properties, they're rehabbing them, and they're exiting them in one of two ways, whether they're selling the property or refinancing and into long-term financing with another lender. And so we very quickly use data to help us, my team, identify those candidates. What we don't want to do is just cold call everybody in the U.S. in hopes of them answering a couple of questions in the affirmative. And so data has helped us be a lot more strategic with our outreach and not, I think, bother people unnecessarily. And so I look for folks that have been rehabbing successfully, 10 flips over the last couple of years. And then I get into more of the particulars of whether their credit is up to where our credit policy requires it to be. Do they have reserves? And do they have the knowledge of the space itself? But we have fairly easy hurdles to overcome. And then our staff is built to help people be successful, not only continue to grow their business in the space, but be successful in using LendingHome.
That's awesome. That's awesome. And now, when you first got started with LendingHome, how have you seen the company grow in the last couple of years to where it's currently at today?
That is a terrific question, especially on the heels of what I experienced with your team around the word of vulnerability. And so I'll start with being very vulnerable in that, as you can imagine, in a startup, you have high aspirations and you want to grow, and you want to grow quickly. And I can tell you that any company that has grown quickly has bruised its knees and chipped its teeth and irritated a few customers along the way, not by intending to do so. It's just not necessarily having the support needed for the growth that it is experiencing. And that's what I heard in volumes over the 2 days in Pensacola, that everybody on the team through seven-figure flipping definitely was growing, but they were unable to get maybe support staff in place in a sufficient amount of time, or to get that additional part of funding in place. And so LendingHome started in February of 2014. They funded 3 loans. Last year we funded over $1 billion. So very rapid growth. And so what we experienced in the early years was we were growing so fast that our support process did not enable us to follow through on what we communicated to borrowers that we would do, which is, we're only going to ask for this piece of information the first time, but not ever again. Our system didn't necessarily identify that we hadn't asked for something from a borrower that was sending us their 3rd or 7th or 20th loan. And so it became a bit irritating that we were re-asking for a piece of documentation that had already been submitted, reviewed, and vetted, right? And so we have subsequently fixed that problem. We've never been in a position where we've not had enough money. Thankfully, we have institutional funding. We have retail platform funding, which is as simple as accredited individual investors like the 3 of us wanting to buy fractional interests in notes, right? I want to buy $10,000 of that note and $5,000 of that note. So we've raised about $150 million of equity. We've raised about $110 million of that retail capital. And then we have warehouse capacity with major Wall Street providers of capital. So money is not an issue as it relates to us from a lending standpoint, but we couldn't hire people fast enough. And that was a theme I heard last week, loud and clear. And I think what we end up doing is, you need to get really good people in. And as your company scales, and I was talking about this with a couple of your coaches, you get people in, and in the first, let's say, year or two, they're absolutely the right person for that role. And as the company starts to scale, the role kind of changes, right? And it evolves. And sometimes the personnel doesn't necessarily evolve as fast as the role will. And candidly, nobody's capable of doing that. It's just a matter of when will the role eventually evolve past a person's capacity. It could be 6 months, and it could be 6 years, and it could be 15 years. But eventually, I'm 54, and I've been in the corporate world since 1989. It always happens. It's happened to me, right? And so so what you have to do is be able to be courageous enough as a business owner like you two are, and ask yourself, is this person still right for the company? If the answer is yes, do we have a role that's right for the person in the company? Hopefully the answer is yes, because culturally they've been with you and they've been pretty solid. And so if the answer is no, then you just have to be super honest with the person, say, hey, this is the direction that we're going in, and here's all the roles that we have available, and where might you slot? Right. And if they don't slot, then, hey, let me help reach out to maybe a company, an industry, et cetera, that might be perfect for you on your growth trajectory from a career pathing standpoint. So, and that's happened both at the current company, LendingHome, and other companies that I've been at. And so now, we're still trying to get enough of the right people, into the company. You still have to, we're a startup. I mean, we've been around for 4 years. What I think we're starting to see is we're starting to attract more people that were hesitant to be part of a startup in the first couple of years. And now all of a sudden we have proven the thesis out that we're a bit longer for the industry than maybe some people were betting initially. And now they want in, right? Which is great. And so I think we're having to convince on a longer period of time and more thoroughly people to join the company, because our success has been able to assist us with that.
That's great.
You just gave our listeners so much information there. Thank you so much on growth, so much on perspective, and just knowing that perspective cuts across every single line of thought. It's a great knowledge to have. So imagine I am an investor, which I am. We are, and we come to you when
easy to imagine.
we say, Ray.
We ask the easy questions.
Yes.
Softballs.
Just imagine that. Okay, we got that. So we come to you. We're like, Ray, we have a project at XYZ State Street. Can you fund this for us? How would you begin the process with us?
Well, the first thing, after just thanking you for even considering LendingHome, is asking you a few questions. So with us, from a qualifying standpoint, we don't dive into at all any income documentation or kind of thorough cash flow documentation. What we've been able to identify is an owner or borrower's experience in flipping. We can see when they've acquired properties, and then when they've exited properties, and then the delta between the acquisition price and the exit price. And so it's very easy to do math, right, to see if somebody has been successful and then how often they've been successful. So initially, the first part of that conversation would be around your experience. So how long have you been doing this, and what are you doing? And so, as you all know, and your listeners probably know from going to your site, there's different elements of investing, and I'll call it flipping in general, right? And so some people get into assignments, right? It's a very quick, not easy, but quicker way of identifying properties and generating some cash flow, although you're leaving quite a bit of the meat on the bone, but it might be for various reasons, which I'm sure you guys have communicated on other podcasts. And so are you somebody that assigns a lot of deals? Are you somebody that wholesales a lot of deals? Do you wholesale things? Do you do up and do a small cleanup, or do you do full retail? And so I think having a perspective of how you all approach a project is going to allow me to educate you a little bit better on how we either can be or can't be a successful partner, and more than likely on that project, right? Because what I heard and have heard over the last 4 years in this space is not everybody does 100% retail, and not everybody does 100% wholesale. It's really a combination, and there's a larger percentage to one and a larger percentage to another, depending upon probably how long you've been doing it, or just what you're comfortable with. right? And so, and how you've built your infrastructure, because one requires a different type of infrastructure than the other. So that's the first one. And that was a long-winded way of answering that particular question, because without that allows me to slot a couple of things. We base what our leverage, or if your listeners like your loan to value or your required down payment, what that's going to be based on your experience. And so that allows me to go, okay, now I can go down this path as it relates to the loan to value that we're going to be talking about on this particular project. And then secondly, we get into the credit or FICO scoring requirements, and then the reserve requirements. Candidly, those are the three main items. The rest of the information that we actually go through is very simple as it relates to how have you structured your entity. Are you in good standing with the state that you're doing business with? That's an assumption, obviously, that we're making, that if you're calling me, hopefully you are, right? And so, but we cover those questions, but not necessarily first. There's some grandiose assumptions that we make, and that's one of them. Plus, we can check it very easily online. So that's the first one, is really around the experience, and then that will decide whether or not this is going to be an initial sort of transactional relationship, first one ever, first one with us, et cetera, or are you quite experienced and there actually might be a different path that we can go down with you relative to providing you a larger sort of credit facility or credit capacity with us.
Sure. And
Great, thank you.
So let's touch on that credit facility. First, it's nice to know that for the listeners, whether this is your first project or you've done 100 in the last 2 years, this is a viable option for you, and they tailor fit a program that can help you work within your scenarios. And now, so talking on a larger aspect for maybe someone who is doing a ton of projects, help us better understand what a credit facility would allow and the pluses with such a facility.
Good question. So as you mentioned, I mean, we've broken our sales team and operations team to support both individuals that have never flipped a home and haven't been able to secure, let's say, private funding or friends and family funding, et cetera. And we have a team that just assists them. It's a bit longer process just because there's a lot more questions, right? So what does an institutional lender do? How is it different from my buddy who got money from a guy at the donut shop and he told him that he got it in a day? And you guys have taken more than a day to, gather my information. To fast forward to an example of somebody who is a more sort of prolific flipper. They're doing a project every other month. They're doing one a month. They're doing 5 a month, et cetera. And so what the credit facility allows somebody to do is not to question whether or not they're going to have access to capital. One of the biggest challenges, at least that is communicated to me by our borrowers, is I can never have enough capital. And so it's just a matter of aligning with capital providers that differentiate for the borrower in different types of buckets. So one could be a large capacity at maybe a friendly rate, but not necessarily a bank rate. And one might be bank financing. And so there might be a bank that very specifically likes a certain area or municipality, right? So that's where that community bank is, and that's where that regional bank is. So they really like that particular area, maybe Newark, right? As a specific example in New Jersey. And so, and then you might have private lenders who are private financiers who don't necessarily have as much capital as an institutional lender like LendingHome, but once they establish a good relationship with someone, it's almost a sight unseen delivery of money, right? They know you've delivered for them 5, 10, 15 times over the last year or two, a quick call, and all of a sudden an hour later or a day later, you've got not only your acquisition financed, but your rehab financed. And then there's different ways that you go about repaying them. So the credit facility from our standpoint enables somebody to know that at the worst case scenario, you've got, in our example, $5 million that we will fund loans for you over this period of time. For us, it's 12 months before we reevaluate credit worthiness again. That is significant. That, as you know, from a flipping standpoint, you're working your leads and you're following through religiously. If you look back in 2017, you may have closed, let's say 24 deals. Since I'm bad at math, it's easier for me to divide 24 by 12. So you didn't necessarily get 2 projects a month. You averaged getting 2 projects a month. You may have actually gotten 5 or 6 in one particular month. And if all of a sudden you don't have appropriate financing lined up, you're less strategic about how you can address those projects. Sometimes you might have to say no. Sometimes you might not be able to fully retail a project when in your mind you're like, gosh, that is a really good deal for us. But we just don't have the staying power from a capital standpoint to deploy that much on that particular project. So you might end up having to assign it or wholesale it just because of lack of financing. And so this doesn't necessarily end everybody's financing capacity issues, but it certainly puts that financing arrow in your quiver to go along and supplement with the other types of financing that you have arranged.
That's great.
So much amazing information right there.
I have 2 follow-up questions, one related and one sort of related, semi-related, let's say. Okay. So the first being, so credit facility, and it's a 12-month term or a 12-month check-in. So if someone starts a project in month 12 or beginning of month 12, how does that carry over with such a facility?
Coincidentally, the term of our loans happens to be the same term of the, I'll call it credit line or credit facility approval. So our loan terms are 12-month interest only, no prepayment penalty. But to answer your question, so if somebody was approved for that credit facility, 10 months ago, and now they're acquiring another property that they absolutely know is going to take them past that 12-month period of time. Well, the check-in that we're going to have is really the two items that we had before. So the experience level's already been vetted, right? So you don't have to requalify an experience because you've only added to it.
Sure.
So right. And so the 2 main things that could change, one would be the FICO and one would be the reserve requirement. So hopefully on the second one, we've assisted you in your growth over that 10-month period of time where the reserves have increased to where that snapshot of time that we require will be met. If not, there's potentially some ways to be able to secure other assets. A lot of times, I know business owners tend to hold money in different accounts, not necessarily just the entity account. So it could be as simple as being able to either rearrange where the assets are, just showing where they're at, and easy enough to qualify for that. And then the kind of the blackish and whitish one is the FICO score. So for our more experienced operators, we require a 660 or better FICO score. So typically what I have not seen in my years since 1989 and working in this industry, unless there's a major event. Usually if somebody has been successful in working, whether it's a W-2 job, self-employment, et cetera, if you're on a trajectory of success, typically the FICO score is going to come along with you. What I have seen is usually when there has been a massive disruption in credit or FICO, if you will, as a result of that credit disruption, it usually was a major event. And so, if we've been lending to somebody successfully and the projects have been successful, it would be completely out of the ordinary for somebody's FICO score to be significantly disrupted to where we wouldn't re-grant credit. I'm not saying we would all the time, but that's what I've typically seen.
Sure. And
so we would just re-up and reapprove them for another 12-month period.
And you are based in California. Do I have that correct?
Yeah, the home office is in San Francisco. So that's where probably 95% or more of our employees reside.
Noting that you're across the country and with all these different market dynamics and with, of course, different cities and being at different points of the cycle, how do you familiarize your process, noting that, one day you may be loaning in Alabama, the next day you may be loaning in New Jersey, the next day you may be loaning in Nevada. How can you make the process thorough or how seamless is it for investors, or how can they help you learn a market if maybe you're not into it?
That's a good question. So we certainly, as a lender, we really leverage data. And what I mean by that is, from a credit reporting standpoint, thankfully, most of the data is standardized, right? So it's in the 3 credit bureaus. And so that part is easy for us. The part that could be a little bit more difficult, and it is in some areas, is the public record information around properties. And so there are some particular areas in the US, not too many, where the public record reporting information around square footage and bed and bath counts is not as accurate as we would need them to be. As you can imagine, when we have an appraiser who's licensed and certified, which they are, we have, I think, 11 or 12 on staff, and they're reviewing information, public record information in a particular area, and they're seeing that it's a 2-bedroom, 1-bath, 790 square foot home, they're going to value it as such. When you've walked the home, the fact that it's 1,400 square feet, it's actually a 3-bedroom, 2-bath. And so when we value something as a 2-bedroom, 1-bath, 794 square foot home, I can guarantee you the price that we're going to value it at is going to be probably below your expectations. And so what we're able to do when that happens, which it has, in these pocket areas, is we rely on you as the borrower and your partners, as Peely mentioned earlier in the podcast, of, do you have somebody like a local realtor that you've been using that can provide us closed, accurate public record information that we could actually use? And so that's where our partnership is going to come into play, as it relates to us needing you versus you just needing us. In particular areas. Most of the time that's not the case, but there are pockets in certain states where Texas is one of them. I mean, they just, from a legal standpoint, they don't have to report a lot of public record information as it relates to buyer-seller information and some property information. And so they, as a state, have chosen to report that, and that's either going to, it hasn't with us, but it's going to disrupt a lender's ability to assess information on more quickly. So it doesn't mean that it doesn't get done correctly. It just means that there might be a time additive for it to be done correctly. Thank you.
Yeah, that's great. And in regards to where LendingHome is at today, is that something that is a difficult point for your business that you're working to improve? Or if not, what is something right now that you're trying to make more investor friendly?
Yeah, certainly there's some ways that we can address the public record information. Some of it is, having either a person or having a particular type of license in that particular area, so that we have access to the data that a local licensed, let's call it, broker has. So if we're not a licensed broker in a particular state, I'll make up a state, New Jersey, then we would have to have somebody that either resides there on behalf of LendingHome, or somebody on LendingHome would have to be, a broker licensed, et cetera. The other item that comes up is, you mentioned that we're in San Francisco. Well, 65% of our business is done Texas East. And so there's at least a 2, if not 3-hour time difference between the two. And so one of the reasons I reference that is we closed over $1 billion last year. 65% of that came from Texas East. So we have been able to successfully address the time zone issue that people would experience. We have certain roles within the company where it's extremely important that we work at the same rate and time as a borrower. So that would be processing and closing. And then we have certain other positions where it's almost irrelevant when they're working, so to speak, that we don't necessarily have to have an appraiser that gets up at 5 a.m. Pacific time, because our process enables us to get through the inventory of work in a very timely manner where it's not disruptive to the whole process. And so what we've done from a processing and underwriting standpoint is we've staggered work hours. So we have people that are working at 8 a.m. Eastern time, all the way up to I think 6 p.m. Eastern time. Not necessarily that particular person's, but we do have coverage from an Eastern time zone standpoint from, I think, just before 8 a.m. to just after 6 p.m. So that if there's questions, which you're going to get, we actually have live bodies that can help push loans through. And then what we have also done is, we've built, I mean, we're a technology company. And so we have built an extremely borrower-friendly portal that enables you in the before hours, meaning before 8 a.m. and well after 5 p.m. to work within our system without needing somebody to be there, uploading documents, see progress about how things are going, communicate electronically, et cetera. So I think we've built our system to be very self-serving until somebody needs help, and then we've built that help to be available.
That's an integral piece that you put there, because if you haven't used a lender before, make note of that piece about where you're located. I have worked with another lender on the West Coast, and it added days to our time cycle, because maybe they don't get into 11 a.m. and I send them something at 10 a.m. and then they don't get back to me until 5 hours later to their time, when I'm already out of the office. And now you lose a couple of days. And as most people know in this industry, the time can be the biggest drain on your capacity, and you usually are short on time, so that can add to your days wholeheartedly.
That's a huge difference. Yeah. And as an investor, constantly building our team, like everything you've just given us is like so support orientated. So that's my next question. How does your support system differ from other lending facilities, capacities, and how can you help from you said you have a team just for beginner investors to people who are doing hundreds, 200, 300 deals a year. So how do you differ from other facilities?
Good question. One of the ways that we've been able to sort of test drive other lenders is we actually have people, at LendingHome that actually do flip homes. And
I love that. I love where we're going with this, by the way.
Yeah. On part of that doesn't answer your question, it enables us to have a perspective that is, first and foremost, real, right? As opposed to, that borrower is just saying that because they want something to be done easier or better or off the rails. So we get a really live experience of going, no, this is exactly how the process is for acquiring a property and being vetted from a lender, and project disruptions and scope of work changes that are unforeseen, right? And closings or title issues that come up at the last minute. So one of the good things, candidly, about this is we do not lend to employees. So actually, we're forced to send them out to competitors. And so the benefit of that is we find out how our competitors' process is. And then we already know what our process is like. And so we're able to compare both, leverage and rates, but then also customer service, availability, visibility into the process, et cetera. So, and I'm not here to throw other lenders under the bus, and I'm not going to mention names, but it allows us, and obviously our borrowers are only going to use kind of high-level lenders, it's very similar to LendingHome, right? Uh-huh. So that would give them the leverage that they want, low rates that they deserve, et cetera. And so I'll leave it at that. And so we've been able to identify that actually our process is quite better and different relative to speed and consistency, meaning when I send you a project like this, you consistently ask for only this, as opposed to, oh man, I send you the same types of projects all the time. Sometimes you ask for this, sometimes you ask for a question that seemingly is very strange. And so to your point, Jason, on the timepiece, is how we've been able to differentiate ourselves is in combination with a lot of things is when we take a borrower through that line of credit underwrite, right? So we thoroughly vet that borrower information. And so we see how your operating agreement is structured so that your loan documents are done correctly. We see what your experience is. We see all the items that you need to meet. That's done for 12 months. So we're not going to re-review you on a monthly or quarterly or semi-annual basis. And so not having that as a disruption piece is huge. And so then all we're doing on a regular basis is reviewing the property transactions that you have. One of the things that we've noticed about the more experienced flippers is they tend to gravitate toward a very similar, not exact, but similar property, I'll call it profile, meaning 3-bedroom, 2-bath, 1,500 square feet, right? And not that there's no variance from that, but it's very similar. And then it may be a sales price that's sort of at or below something. What that does, as you know, is it gives you options. So do I acquire rehab and sell? Do I acquire rehab and rent? So if you keep everything in that sort of box, it gives you significantly more options. And I think most rehabbers are looking for options as it relates to finance, as it relates to exit, as it relates to a lot of things. And so our process is built to make that even faster. As you can imagine, if you guys were underwriters and I was sending you loans and all I sent you was the same type of loan or property in the same type of area, pretty much I'm only underwriting it right-handed as opposed to left and right-handed. It's just a lot easier. So believe it or not, as easy it is on you, it's just as easy on us. And so, and when something does go off and it's a property outside of an area that we typically do, we'll do it. It just might take a little bit of time because it might not be a property that we do a lot of times. Maybe it's a rural type of a property. Maybe it's on excessive acreage. Maybe it's a $2 million home, right? And so typically what we see are loan amounts our average loan amount's $205,000. So, we probably close several $1 million+ loans, but it isn't common. So it's on a different, I'll call it rail, but we accommodate it, but it's more of on a slower pace initially than the homes that are your standard ones that are, $50K to $1 million.
You said something key for newer real estate investors or even seasoned out there is that the most predominant factor to investors that you see flipping at a high volume is that they don't do HGTV where every project is new thing. They have to think of 50 different things to do within the home. They're doing the same footprint day in and day out, the same model home. And that's where they see the most success, creating systems to be able to do that model over and over and over again to create their revenue. So if you were, hopefully you caught that note in there because we see it in our group. People are just crushing it, doing 200, 150, 200 flips a year with literally just the same house, the same ranch,
they do
day
the
in and
same
day out.
thing.
Yep. 3-2,
They have
3-2,
the
3-2, 3-1.
It doesn't mean that they're not doing the finishes really, really well.
That's correct.
It just means that they've already predetermined how they're going to approach a house as it relates to the finishes. So they don't have, every home is not a new decision-making process. They've made the decision. They're beautiful homes. They just made the decisions in advance.
And that's,
to your point, they've eliminated that time issue that I think most people do, right? And this isn't my opinion. This is rehabbers' opinions that they share with me, that you also share with your podcast folks, is do not go about a rehab as if you're going to live in the home.
Yep.
You will overspend both on money and time significantly. So that is one of the things I've absolutely learned from, your group and others.
We've learned it too.
Time and time again.
We've learned it. So exactly right. So go ahead.
Well, I was going to ask, what has been the biggest challenge for you at LendingHome, and what have you learned from it, and how were you able to rebound?
Biggest challenge,
or in your life in general as a lender, or the difference between working with investors or working with home buyers. Like,
sure.
what's the give us something that you have taken
as a learning
huge
step.
Value from.
Yeah. So I think one of the major differences or the learnings that I've taken is when I was in an operations role, it's very easy to look more at the big picture, right? So we're closing 500 loans a month. We need to make sure they're all going through smoothly. At times, it's very difficult to see that one loan that's going off of the rails a bit and give it the nurturing that it probably deserves. Because when you statistically look at that one loan out of 500, it is such a low percentage of either failure or disruption. You tend to kind of move on to the others, right? You're always taught to, you have strengths and weaknesses. You want to shore up the weaknesses to where they're not significantly disrupting your successes, but you want to accentuate your successes to the point where you can 3 and 5 and 10x your success. And so one of the things that this shift in role has allowed me to do is truly, and I'm in front of customers live, just like I was in Pensacola. And so there is no hold button when you are live in front of somebody, right? There is when you're on the phone. So you can call somebody, and if all of a sudden somebody catches you and you're like, oh my gosh, I don't know that, you're like, hold.
Yeah.
And so think a little bit, right? And then you can get back to them or just say, hey, I've got another call, et cetera. When you're live with somebody, you see the issues that they're experiencing and the struggles. And I think one of the things that you get caught up, whether it's LendingHome or anywhere else, we are the largest provider of fix and flip financing in the U.S. Like we're the largest. And so it's very easy when you read your own press clippings to go, we're pretty good, right? And so nobody's better than us. So why would everybody not want to do business with us? And so what I've learned in this new role for me is there's a lot of financing options out there, and not everybody is really open to taking conversations about LendingHome, whether it's they know about us and don't need us, or they've heard about another institutional lender or hard money lender, whatever you want to categorize us as, and they just assume that we're going to be the same. And then they probably, when you're an experienced rehabber, you're getting 10 or 15 or 20 calls a week from people just like me, right? And so they may or may not have the track record that LendingHome has, but the call coming in, the person has no clue about that. And so I think one of the struggles is trying to communicate our value proposition, and so that it aligns with the growth that a particular borrower is trying to experience, right? And so, because there have been times where I've had to admit in front of them going, I actually don't see any alignment today between LendingHome and you. So maybe I'll call back in 6 months or 12 months when, your circumstances might change. And that's okay. That's like a borrower coming to a project and thinking, I have to buy this house because I need inventory or else. You don't. It's okay to say no, right? Because your experience is going to tell you that thing's going to end poorly. A newer flipper is not going to know that, right? They just need inventory. Maybe they heard that or they've experienced that, et cetera. And so you do need inventory. You just don't need bad inventory. Sure. And so I think those are the things that I've learned about myself is, I have a terrific wife and 4 great kids. And one of the things I've learned in my marriage is I always need to be learning to listen better, because I've been a crappy listener in the past, right? Because I've listened from a point of wanting to talk next, as opposed to truly listening to understand. And so what this role and those experiences have taught me is to be a better active listener, so that we can more appropriately position LendingHome to truly benefit somebody, as opposed to being, Sammy the slickster sales guy just trying to pitch something and then follow up just aggressively, on the phone to get somebody to, arm wrestle them into submission, if you will. And so I've learned it's okay to say no, and it's okay if you're misaligned. It might not be a misalignment forever. And if it is, there are other people that can use us as a resource. That's and right. So you kind of just move on, you respect their time, respect my time, and move on. Yep. So
you've given us so much value. Wow.
If that answers your question. So.
Sure. Yes, no, it does. And I can touch on a couple of things you just said there. The first thing that pops up into my mind is that you said there are a lot of financiers, lending opportunities out there. There's a lot of money out there. Mm-hmm. So one objection I hear, especially from newbie investors, is that I don't have the money. I can't find the money. But you just heard a lender, folks, say that there is a lot of money out there. Yeah. Do not use your lack of funding. Do not let that stop you from getting into this business. If this is what you want to do, call up LendingHome. See if there's something that they can do to help you. They have an entire team that can help you. The other thing that you talked about was it's okay to say no. Yeah. That's amazing.
Yeah, you want to make sure that your lender is aligned
Yes.
with your projects as well. So
Yes.
at that point, you want them to be happy with it just as much as you want to be happy with your lender. So, well, two more questions for you, and then we'll let you go. So thank you so much for the time. What would be a piece of advice you would have for a new real estate investor, and noting that we're not talking from an investment standpoint yourself, what would you have as a piece of advice that you see a lot from a lending side for someone who's just starting out that can maybe help them stay on track?
I think to Peely's point, there's a lot of options available. I don't necessarily know that you need to, the phrase, how do you eat an elephant a bite at a time? I don't think somebody's going to get into flipping and be prolific within their first project. I think it's unusual that somebody is significantly successful within 12 months. It's what we've tried to do with our new borrowers is we define success as that borrower not funding their loan. That is actually not success. Success for a new borrower is them exiting that property profitably, because now they have an option to actually be successful on flip number 2 or project number 2. And so whether it's with LendingHome or not. And so that, because it's irrelevant. I mean, I think what we want to do is mitigate the number of unnecessary flipping disasters, if you will, that take place. And a lot of times what we see is just in the data and then narratively as I'm in front of borrowers in different areas of the US is you tend to have folks that, again, they need inventory so bad that they're willing to pay on a particular piece of property, thinking that they can make some changes to the project to where it's actually going to exit at a higher price than what homes are doing in the area. And so you have an inexperienced person that's thinking that they're going to set the new mark in a particular area, and you have an experienced person that's saying that's not going to happen. And so when that loan comes into LendingHome, the amount of just ill will that comes from us saying that area is really selling for, I'll make up a number, $350,000, and that particular borrower is thinking, no, based on where I'm buying it and what I'm doing for, that thing's going to be worth $450,000. And I'm not saying that it won't be worth $450,000 on paper. We're saying the data supports it not selling for $450,000, right? And so I think from a lending standpoint, and it's unfortunate, right? I'm not saying that it won't. If that person sells it for $450,000, that's awesome, right? It's great for the market. It's great for the industry, et cetera. What we can't do as a lender, whether we're private or not, we can't help a borrower set that new market if the data doesn't support it. And so what we're trying to do is hopefully help them see that they actually might be biting off more than they can chew. And so we become an educator. What we're coming across is we're like a disciplinarian, right? We're slapping their knuckles with a ruler, when in reality we're saying the data doesn't support this. Maybe you should go to somebody in your area, maybe a RIA, local RIA, et cetera, and get somebody else's perspective. Whether it's you're using the wrong lender, or you're biting off more than you can chew. We certainly can be wrong with where we're valuing a particular property, and if there's somebody else that will fund it, I think that's great for them. As long as they can successfully and profitably exit, I think that's terrific.
Love that. That's great. That's great advice. And when people are looking for funding for their next project, what is the best way to reach you and or LendingHome?
LendingHome.com. So that's the easiest way to do that. And it will allow somebody, regardless of their experience, to kind of connect with the right individual. I travel a ton, and so I think reaching out to me is fine. I would probably then take that call and refer them to somebody internally that could more quickly jump on their questions and particular project. But the easiest way, just from a systematic standpoint, is to go to LendingHome.com.
Amazing.
Wow.
Well, thank you. This has
been
so highly informative. And we know a ton of listeners are going to be set in the right track. And that was the whole point of this this episode. So thank you so much.
Oh, you're very welcome. I appreciate you guys extending the invitation.
Great.
Again, thank you so much to Ray Williamson.
Yep.
And thank you to everyone out there for listening today. We're so grateful. So this is the REI Foundation podcast with Jason and Peely. Thank you again, and we will talk to you later. Bye.
Bye-bye.